Hi everyone, I'm Peter Kim, joined with Michael Henley. Just want to give everyone a quick update on everything that's going on in the markets and how we've changed our models.
Outstanding. Well, thanks, Peter, as always, for your time. Let's talk about the market this year. So it seems like, as always, the U.S. is taking over and crushing it versus foreign. So let's talk through it.
Yeah, everything tech so far this year has been doing well. Markets have had a great year. S&P's up double digits. NASDAQ is up almost 20%. Even international markets are finally starting to see some positive returns, which is great to see. And like any good counter-cyclical environment, you want to have the bond market not performing as well and the stock market is doing well. That's exactly what you're seeing with the bond market being slightly negative right now.
Good stuff. And it seems like emerging markets, are they emerging or are they submerging?
They're continuing to emerge. I think you're seeing pockets of growth. India is doing extremely well, which is great to see. China certainly struggling a little bit, but they can kind of spend their way out of these issues. So at some point, they will kind of force their will upon growth.
Okay, terrific. Bond market seems down this year. Anything we should be concerned about there, or just normal?
No, I think credit quality is still pretty good, especially for our portfolios. If we were holding a lot of junk bonds and high yield debt, I'd be a little more concerned about it. But we strategically try to avoid those areas and have very high credit quality positions, a lot of U.S. Treasury exposures. So nothing to worry about from our side.
Okay. All right, terrific. All right, Peter. So the Federal Reserve this year seems to be the topic everyone is focused on. Interest rates being cut. What's going on with the Fed?
Yeah, it's good to see that inflation is going down. So it's finally going down. We're down to about 3% year over year for June, which is great to see. Fed is now ready to cut rates. It's just a matter of when. July seems a little optimistic. September seems much more likely, but that's a huge boom for everyone. So we're starting to see everyone start to anticipate that a little bit more so. And we're expecting that to come at some point with potentially 1, 2, or even 3, depending on how the economy fares for the rest of the year.
3 rate cuts this year.
It'd be a very bad scenario, I think, if that happens for the economy. But that's kind of the, oh no, we've done too late. Now we got to really cut.
Got it. Okay. And with cash still paying about 5%, I guess the spread between inflation and cash is pretty healthy then right now.
All of a sudden, yeah, you're getting a positive return on cash compared to the inflation rate. So you're getting a real return that's in the positive, which is nice. I don't think it's going to last forever.
Right.
But at some point, yeah, ride the wave while you can.
On the bond side, are we extending duration to capitalize on the rate environment?
It's a great question to ask. You're absolutely right. We have extended duration a little bit because when you have a rate drop, all of a sudden the price of those bonds will go up in proportion to kind of what your duration level is. So we've been slowly extending duration, but we've been very prudent about it. And we've also been very concerning in terms of what kind of credit quality we're taking on for that added duration risk. So we've increased our credit quality to kind of offset that added duration.
Do we have any, let's call it junk bond exposure or high yield exposure in the portfolios?
Thankfully, we do not. So it's one of the areas where it has been a bright shining star because the economy has done really well. Historically, with high yield bonds, you're getting equity volatility for bond-like returns. Not a really good risk reward trade-off. So for right now, we've been out of that market.
Okay, terrific. What are you looking at right now, given the current economic environment? Like what indicators you're looking at and what have you?
Sure. So right now, 2 of my favorite indicators that I'm looking at are the JOLTS data and consumer spending.
What, JOLTS, is that like a soda pop or is that
Exactly. So job openings and labor turnover. Basically, it's kind of the real-time look at how healthy is the job market and labor market. So job openings have been declining.
Okay.
Turnover rate, so people quitting, getting laid off, is basically kind of stabilized. So all of a sudden you're seeing this get a little bit more compressed, a little bit weakening of the labor market. That's a little concerning because that's showing that the economy is slowing down as well. But then also to kind of offset that as well, to complement that, I'll say.
Yep.
Consumer spending is slowing down as well. Retail sales have been continuing to disappoint.
Okay.
So consumer capacity of spending is pretty much tapped out. We're on credit. You're starting to see that kind of snowball now into consumers pulling back. Those are the 2 areas that I'm looking at on the negative side. Positive, productivity is increasing. That's a big disinflationary force for us.
Is it AI driven or is that just?
Some of it could be and some of it should be at some point.
Right.
We spent trillions of dollars on artificial intelligence. At some point, you got to think that money's going to have a return on investment.
Right.
So any day now.
Okay, good stuff. All right, for Brandywine Oak clients specifically, what changes have we been making or did we make this quarter in light of the model portfolios?
Yep, so I would say that we are still aggressively neutral in everything we're doing right now because we've let the stock market continue to run, which is a good thing to see. So the markets have drifted our portfolios. We've allowed that drift to basically just maintain at that point.
Okay.
So we're slowly increasing our equity exposure back to our strategic tilts, kind of where we want to be. But to offset that, we've also then increased duration, increased credit quality on the fixed income side, and tactically just made a little bit of rotation from taking profits off of gold moving then into a more depressed area like real estate. So just very, very minor tweaks around the periphery to continue to ride this wave.
Okay. And gold, is it still at all-time highs? It seems like gold has been, in light of rising rates or high rate environment, stock market doing well, it's done very, very well for a risk-off asset, I guess.
Yeah, gold is finally in favor again. It's nice to see. Commodity super cycles are in theory about 30 years long. I don't know if gold's going to have a 30-year run in it, but being at all-time highs, you might as well take advantage, sell at a relative high, buy something that's at a relative low, and continue to diversify the portfolio.
Only because it's all over the financial media. This Ethereum situation coming out. I think Bitcoin now, Larry Fink, the CEO of BlackRock, came out and said that, hey, I was wrong about crypto entirely. Hey, I take back what I said. It is the digital gold after all. Ethereum, what's that all about? Is that something that we should be expecting?
Ethereum is going to be a big deal. It's kind of the other end of the spectrum. So Bitcoin is digital gold. Think of like Ethereum almost like a version of a dollar where you can create more every single time whenever you want to. It generates its own revenue off of it with those transaction costs.
So it has revenue.
It does have its own revenue. You can also stake it and earn interest off of that as well if you wanted to. So it has a lot more flexibility and capability in terms of usage. And it's also much easier and cheaper to generate compared to Bitcoin.
Okay. And if clients own the crypto index, do they have Ethereum exposure?
They do.
Okay.
So they have about 30% of that portfolio is in Ethereum because it's about the market weight of what Ethereum is right now.
Okay. Terrific. Outstanding.
Great.
Well, thanks, Peter, for your insights.
Absolutely. Thank you, everyone, for taking the time to sit with us and hear about our insights. If you have any follow-up questions, please feel free to reach out to your relationship manager. On behalf of Brandywine Oak Private Wealth, thank you.